Hello, everybody, and welcome to the Like a Tortoise channel. I'm happy to have you all here on Monday. Hope you all had a great weekend as well. And today I want to talk about a post that was made by none other than Monish Pabrai. For those of you who don't know him, he's a prominent value investor who has compounded money at very high rates of return for decades. So he's certainly I like to pay attention to. And Monish Pabrai, of course, has a strong opinion in terms of what the S&P 500 can deliver over the next decade. And I tend to agree. So today I will delve deeper into his post and let's try to break it down. So I'm not sure if you are following the post, if you are following the channel, then you know that we follow an active approach to investing, where we try to identify high quality companies when they are trading at a significant discount to what we call the intrinsic value, so the real value. And the problem that we are having in this market is that it's getting harder, right, to actually uncover value in a market that is so overpriced. And granted, most companies that are really pricey are all concentrated in the AI space, but still the breadth is actually also broadening. And so, even stocks in different industries are now getting pricier, but you can still find great value. And in fact, we still believe that many of the companies in our portfolio still offer great value, even though many of them have already run up substantially. So guys, why is this? Why is Monish Pabrai saying that? He said that in 2000, the S&P 500 had an elevated trailing PE of 26, PE price to earnings, well above its long-term average of 14. For the next 12 years, the S&P 500 delivered zero returns, and the current S&P 500 trailing PE is 30, even higher than 2000. And then he says, history rhymes. And so I wouldn't be shocked if you told me that the next decade would be a lost decade for investors returns wise, okay? Because that's exactly what happens, guys. I mean, when things are so overvalued, the risks go up with rising prices and not the other way around. So for example, if I showed you the S&P 500 over time, yeah, look at this, the S&P 500 over years, you can see that there have been many periods where you just made no money. In fact, if you go back to the 30s, you had to wait 25 years just to break even. And then you had a massive 18-year run-up, and then you had to wait 90 years. Yeah, if you bought at the peak of this bull market, you had to wait 9 years to break even, all right? And then you had another 17-year plus run-up. And then if you bought at the peak, then you had to wait 12 years just to break even. And now we are in the longest bull market ever. Okay, so I mean, this bull market has been the strongest of all. That's number one, because the returns that we have seen ever since 2008, you can go back many years, but nothing matches them. And they have been largely driven by Federal Reserve and central bank intervention in QE, right? Quantitative easing, putting money in everyone's pockets without them needing to work, as we saw during COVID. And what that does is that leads people to actually put more money into the stock market, and just that continues to bubble up. At one point, this is going to end. All right, I'm not a forecaster. I'm not a fortune teller. I don't know what's going to happen, whether this can continue to go up over the next five years, 3 years. I just have no idea. For me, I mean, it doesn't, whether this thing crashes or not, I'm going to be happy because I'm an active investor. I try to select a basket of great companies, and most of them, in fact, all of them are trading at valuations substantially below the market as a whole, right? And so that really doesn't bother me. But if you are an index investor, and if you happen to be in your, for example, 40s or 50s, hoping to retire in the next, say, 20 years or 15 years, I think this should be, should cause some concern. And you should at least do more due diligence and see if you are okay with that risk. Okay, very, very important to understand, because something similar can and will happen. I just don't know when. But if you see, for example, where we are right now in terms of concentration, I even have the Schiller PE ratio right here, and you can see that currently we are almost at 40. I mean, guys, this only happened once in history, and it was during the 1999 bubble, tech bubble. The Schiller PE got to as high as 44, and now we are at 39. So the second highest valuation in history from a Schiller, based on the Schiller PE ratio. And for those of you who don't know, this is basically the the price to earnings ratio based on average inflation adjusted earnings from the previous 10 years. Okay, though it's cyclically adjusted PE ratio, and so I think it's a lot more accurate than the normal PE because it accounts for the inflation as well, right? So I mean, and now what that we are seeing the markets, I mean, coming off the recent highs, ever so slightly, people are getting nervous. But you have to understand that this is nothing. A 3%, a 4% decline means nothing in the grand scheme of things, because if things really get nasty, you're going to see like a 15 or 20% pullback, and that should really scare many of these index investors, and can of course lead to more selling, which should create additional selling and then lowering prices. So it's something to keep an eye out on. I want you guys to be always prepared. And retail investors, people like me, have been conditioned to buy the dip every time they see a 3 to 4% decline. They will just immediately buy the dip, because that's exactly what's been working since 2008, and certainly since this pandemic, the pandemic, right, or the COVID pandemic. Every time you buy the dip, the markets then essentially rebound over the next few weeks or months, and that still continues to condition people to buy the dip. But at one point, buying the dip will not gonna save you, because the markets will be under tremendous selling pressure. Okay, so I just wanted to shed light on these comments from Monish Pabrai, and I do think, like him, the S&P and the US indexes, not just the S&P, but mostly the Nasdaq, which is comprised of tech companies, they are really overheated right now, and all it takes is just one of these companies to miss, even if by a hair, and the stock is not going to come down 50%, it will come down 50%, right? 50. And that alone is pretty significant. Our portfolio continues to do very well. We continue to hold great companies. By the way, we continue to hold tightly to our largest position, Alibaba. They are reporting earnings on Thursday, so one of my videos this week will be on that earnings report and following conference call. I'm very much looking forward to it, and I still. And then that aside, only two more companies are left. They are Ulta Beauty and Lululemon, both of which are reporting in December, if not mistaken. So I'll keep you guys. Posted. But another thing that I want to say is that this weekend. Yesterday I had the great privilege of joining Tom Hees. For those of you guys who don't know him, he has a very he's a hedge fund manager and he's known as the turnaround Tom, exactly because he buys high quality companies when they are significantly marked down. He's even more aggressive than me, when we took a picture. Yesterday, as you can see. In fact, I shared this right here. You can see us right here too. So Tom Hees, if you are not following his hedge fund, if you're not following hedge fund with Tom Hees on YouTube, then I think you should definitely do that, because you can learn a lot by listening to what he says. He has 25 years of experience, and he creates a lot of value for his listeners. I knew that he was in London over the weekend, so I just decided to email him, and he was so kind as to reply. And and we really, we just got together. So it's great stuff, and we shared, many thoughts on current valuations, on the portfolio construction. So I learned a lot, and that's, well, more knowledge that I do hope to pass on to you guys as I put out more content like this. In fact, one of the things that I want to do, and he told me that he will be willing to do that, is to bring him on our YouTube channel and actually do an interview with him. Okay, so guys, let me know if this has been helpful. If so, smash the like button, because it really helps the YouTube channel to grow. And just share this with something that you care about, that is heavily invested in the markets but doesn't know what he's doing. Unfortunately, we see many people like that, and I do fear for them, because the market has become a casino in many ways. And if you believe the next 15 or 20 years are going to be like the previous 15 years, you are falling into a common trap known as recency bias. And I think that's just a big mistake. Okay, let's not take things for granted, because eventually things end up reverting to the mean, and you can see that the mean for the S&P 500 on a Shiller PE ratio is 17.31 times. Yeah, going back to the early 70s, and we are now at 40. Now, granted, you can make the case that companies are less capital intensive, right? So they are lighter. I understand that, but still a PE of 40. If the S&P, the valuation just comes down to, say, about 20, about 25, 26, you're going to see a lot of pain, okay? Because for that to happen, the S&P will come down like 40% ish, and you will see a lot of people getting hurt substantially. So just let me know in the comment section if you like this, share it, and I will post more videos this week. Okay, cheers, guys.